Let's walk through just a classic head fake. What is a head fake? A head fake up to go down. What the hell does that mean? Well, first it starts with a box, and you could take this and say that's kind of a range. You can go inside and say that's kind of a range, right? Well, if we were to look and just draw out what this all means, if you have a consolidation box, and you got the market banging in, making the box, and it jumps up and then heads down, and that's what it ends up looking like. Let's draw it down here. So you get a chop, get the market that jumps and then does that. That's what it looks like at the end. A head fake. Faked to the upside and then headed to the downside. What's the anatomy of that? Like, why is it? Well, if you think about trading as other people's positions and you think to yourself, can a market go down? Does it make sense a market goes down when a lot of people are short? If a lot of people are short, that means there's a lot of people trying to buy it lower to cover those shorts for profits. So if too many people want the price of anything to go down and they're positioned short because that's their prediction, it's hard for it to go down because we know that shorts equal future buyers. And if you got many, many shorts, you're going to have many, many future buyers. That's not advantageous for lower prices. If it's the price of a car, a plane ticket, a house, whatever, many future buyers are going to make price go up, not down. And so, what if you were able to do something to shake out the people who are short all inside here, inside the recent consolidation? Heck, shake out people that were short from up here and they're still short from down here, short from anywhere. Anytime you could shake out one position, one side, there's two sides, longs and shorts. If you could shake out a bunch of shorts, what you also shake out is future buyers. So remember, if you eliminate shorts and shorts equal future buyers, then you eliminated future buyers. It's one thing you have to eliminate for the price of anything to go down. People that are willing to buy it lower. Well, that's what shorts are. Shorts are people who are not only willing to buy it lower, they want to buy it lower. In some cases, they have to buy it lower. And so if you could eliminate shorts, you can eliminate future buyers, which is what you have to do for the price of anything to indeed go down. So we get this classic head fake right in here on 10 o'clock Central, where we're just chopping sideways and we go up real quick and down real quick. Before we go down real quick, we've seen it jump, show a couple triggers up there, and then when it gets through the middle of the congestion is really when it's on its way to release to the downside much easier. Do you have to get short at the top of the head fake? No, probably not even try because you don't know it's a head fake at that moment. When it jumps back down, now you can anticipate the probability that a head fake is is taking shape. And so if we magnify it, that's what this chart on the upper right is. Let me back up a little bit. So we're going sideways, and then just look at the chart in the upper right. We get a jump, boom, right there, okay? And before, happens quick, and before we, there we go. You get this jump, and then right in here, when you jump down, you got to be, let me pause it. You got to be willing to say downside, right side, and now play it from the short side, which means you're trying to qualify a short. If you're looking at this in real time and reading it in real time, it's much easier to catch. Talking about it 5 minutes, 5 hours later, then it's like, how could I have gotten in? You have to anticipate what's going on. You know a head fake already shakes out shorts, which means less future buyers below, which is bearish. Okay. There's another thing that you do in a head fake up to go down is you tease, tempt, and bait longs. You actually create more longs. Why? Because the market's breaking out to the upside and everybody's reaching to get on the upside team, which is opening long positions. So not only in a head fake do you, in this example of head fake, do you eliminate shorts, but you increase longs. You go from a little L to a bigger L. if longs equal future sellers, which they do, then more longs are going to equal what? More future sellers. And in this math down here, right, these equations that we're jotting down, we've got more longs equal more future sellers. If we have less shorts, what do we have? Less future buyers. This combination right here, right there, isn't something that's helpful for the price of something to go down. It's not important for the price of anything to go down. It's imperative. It's necessary. It's why it goes down. It's not like, well, it'd be helpful to have more future sellers and less future buyers. No, it's not helpful for the price to go down. It's necessary. You have to have it. This is ultimately what you're predicting, by the way. As a trader, investor, doesn't matter. You're predicting future buyers and sellers. And we try to do that with present longs and shorts, not present buyers and sellers. Well, that's somewhat important. It's not what we're trying to predict. You can't predict present buyers and sellers because they just happened. What's there to predict? You see it. It's happened. They shook hands. You have to predict in the future what? What are we predicting? Well, the future location of price. We think it's going down, we're bearish. If we think it's going up, we're bullish. Okay, yeah, that's what we're predicting. But what's going to make it go up or down? Well, it's future buyers and sellers. So ultimately, know what you're predicting. Most people that have traded for many years unsuccessfully or around zero, P&L wise, they never even think of it that way. They've never thought of it that way. What they're ultimately predicting when they're trying to create an opinion of getting long or getting short, is it going up or is it going down? They never get themselves to click. You have to understand that for anything to click. What you're actually predicting is future buyers and sellers. And why would they come in? And the why has to be simple. Well, why would future buyers come in? Well, because you just added a bunch of shorts. Shorts are buyers. Well, what if you eliminate shorts? Shake them out. Then there's less future buyers. Isn't that what you need for the price to go down? Yes. Would it be helpful to have less future buyers? No, it's not just helpful, it's necessary. Then you add other things like a headline came in right at this moment, which if you follow anything like you're supposed to, if you're trading S&Ps, oil, anything that's affected by the Iran war, well, then you have to know what headlines mean. Do they mean anything? Sometimes they don't. Where are we with the headlines? At this moment, we were, and it might be a deal on the table. And then it was like, nah, maybe not. Iran's walking it back. This is all in a 3-hour period. And then wham, a U.S. senior official says, nope, not good enough. So it didn't just create this head fake or on the backside of the head fake, but it kind of, in this case, would have been just a kind of a rational downside, right side played from the short side, because now you have a chart pattern, a head fake that's happening in real time, which is shaking out shorts, makes it easier to go down. That's a bearish pattern, along with a bearish geopolitical event that just dropped. And then you get yourself in a position, ready, aim, fire, downside, right side, and the market, if I fast forward it, goes right where we thought it could go. You still got to put yourself in a position to pick a good location, but downside, right side is predictable because you know what you're predicting now. You're predicting future buyers and sellers. When you shake out shorts, there's less future buyers. When you trap longs, there's more future sellers. Two things you need for the price of anything to go down. And then, oh, by the way, you get a bearish development in an important geopolitical event that's influencing all markets. And you get oil to rally, that's been bearish stocks. You get, some of the related, what we call ancillary markets that affect every market anybody trades, has other markets that influence it. And so that was, did you have to be short, get short in this period? No, but you shouldn't have been looking to get long, for crying out loud. Should have been bearish at around 10 o'clock Central on this 18th day of May. Is that what it is? You should have certainly been bearish, but for crying out loud, you should not have been bullish and been stuck in a long position on this move down. And that's, again, step one and step two. Step three are the triggers that we have of breaching a blue triangle with a pink. That's a trigger to get on the team, as we used to say. Further back, jumping on a pink triangle, knowing where your risks are, being able to wait, seeing a breakout because you're bearish in here for a pink triangle to see if this is the time, and it would have been. And that's a trigger. We even take it further back. You're getting through the middle of that chop. We talked about a head fake. It cut right through the middle of this. We got our laser green. That's bearish. You got an advantageous rejected market order right there. Big buy market order. Again, you got long stuck. So there's triggers. That's step three. That's fire, ready, aim, fire progression. But your ready and aim are both checked. Those two boxes are checked. Ready is your opinion. That's downside. We went through why. Aim are these locations. The red dotted line, the green dotted line, and so on. And then your triggers could be the pink triangles, could be the breach of the blue triangles, could be a rejection of a buy market order, could certainly be the laser going red to green, staying green, getting greener, which is more longs. That's what you want. You don't want to be long with other longs. You want to be short with other longs. Going back to longs equal what? Sellers. What do you need for the price of anything to go down? Sellers. Well, long, they're future sellers. That's what you need when you're short. You need future sellers. Hopefully that helped